The stock market has already fallen sharply in 2025. Tech stocks are down, global markets are volatile, and economic uncertainty is rising. Is the worst behind us? Or is this just the beginning of an even bigger financial crisis? More importantly, what should investors be doing right now? In this video, we'll break down why the stock market has crashed so far in 2025, key economic risks that could push it even lower, what expert analysts predict for the rest of the year, how smart investors are positioning their portfolios right now. Let's dive in. Chapter 1. What's causing the 2025 stock market crash? The market decline is not random. Several key factors are driving it. Factor 1. Interest rates remain high, hitting corporate profits. The Federal Reserve and European Central Bank kept rates higher than expected in Q1 2025. Higher rates equals more expensive borrowing. Companies struggle to expand. Stock prices fall. Example: high-growth stocks like Tesla, Nvidia, and tech giants have dropped over 20 to 30% from their highs. Factor 2. The economy is slowing down. GDP growth has weakened, and companies are cutting their revenue forecasts. Consumer spending has dropped, signaling a possible recession later this year. Example: retail stocks like Amazon and Nike have reported lower than expected sales. Factor 3. Corporate layoffs are increasing. Big tech and finance companies have started mass layoffs, similar to the 2008 crisis. A weak labor market is historically a leading indicator of a deeper recession. Factor 4. Geopolitical and global economic uncertainty. China's economic slowdown is affecting global trade and supply chains. The Russia-Ukraine war and Middle East tensions are pushing oil prices higher. The 2024 U.S. election aftermath has caused market volatility due to policy uncertainty. Key takeaway: the combination of high rates, slowing growth, and global instability is putting heavy pressure on markets. But is this a temporary dip or a long-term crisis? Chapter 2. Will the market recover or fall further? Let's look at historical trends and expert predictions. Scenario 1. The market recovers in late 2025. Some analysts believe we are near the bottom and expect rate cuts in Q3-Q4 2025 to fuel a rebound. Bullish factors. The Federal Reserve pauses rate hikes or cuts rates. Markets rally. AI, green energy, and tech stocks lead the next growth wave. Scenario 2. The market continues to decline into a 2026 recession. Some analysts warn that the worst is still ahead. Bearish factors. If inflation spikes again, central banks could keep rates high into 2026. Corporate earnings keep falling. More layoffs. Recession deepens. What the experts are saying. Goldman Sachs expects another 10 to 15% drop before a recovery. JP Morgan warns that the S&P 500 could hit 3,800 if economic conditions worsen. Morgan Stanley sees an opportunity to buy only if tech stocks correct further. Key takeaway: there is still significant downside risk, and investors must be prepared. Chapter 3. What investors should do right now. How should you adjust your investment strategy in response to this market crash? 1. Build cash reserves for buying opportunities. Cash is king during market downturns. If markets drop another 10 to 15%, long-term investors can buy high-quality stocks at a discount. 2. Shift to defensive stocks and sectors. Best sectors during economic downturns. Healthcare, Pfizer, Johnson & Johnson. Consumer staples, Coca-Cola, Procter & Gamble. Utilities and energy, ExxonMobil, NextEra Energy. 3. Avoid speculative stocks, AI, overhyped tech. Many high-flying tech stocks remain overvalued despite the decline. Look for strong earnings and solid fundamentals, not just hype. 4. Consider dividend stocks for passive income. Dividend stocks provide cash flow even when stock prices fall. Examples: AT&T, McDonald's, Verizon, JP Morgan. Key takeaway: long-term investors should focus on stability, cash flow, and buying opportunities. Chapter 4. Final thoughts. What's next for the market? Bottom line: the stock market has already crashed significantly in Q1 2025, but the worst may not be over yet. Investors should stay defensive, build cash, and wait for the best opportunities to buy. Historically, market crashes have created the best long-term buying opportunities. What do you think? Has the worst passed, or will the market fall further? Comment below. Subscribe for weekly